Quantitative easing, how central banks print money without printing it. You've probably heard of quantitative easing or QE thrown around in the news during the financial crisis. It sounds complicated, but at its core, it's just a fancy way of saying central banks are pumping money into the economy. But how does it really work? And what does it mean for your wallet, your investments, and the economy as a whole? That's exactly what we're breaking down today. So, to start with, what is quantitative easing? Quantitative easing is when central banks, like the Federal Reserve, create new money digitally and use it to buy financial assets. Usually that will be government bonds. So here's the idea. When the Fed buys bonds, it gives banks cash. With more cash in the system, interest rates fall and it becomes cheaper to borrow. Businesses and households can then borrow, spend and invest more. That's a kind of basic idea of the objective of quantitative easing. So instead of physically printing money, the Fed uses its balance sheet to inject liquidity into the economy. I hope that makes sense. So why do central banks use quantitative easing? QE is a tool used when interest rate cuts are not working or haven't been enough. Take 2008, for example, the crisis of 2008. Rates were nearly zero, but the economy was still stuck. The Fed launched QE, buying trillions of dollars in bonds to stabilise markets and encourage lending. We saw it again in 2020 with COVID-19, when that was a huge shock around the world. The Fed rolled out massive QE to calm panic, keep credit flowing and prevent deeper collapse. So QE is basically the central bank's emergency button, emergency lever when the usual playbook stops working. So how does QE affect you? Well, it has ripple effects that hit your life directly. Lower borrowing costs, mortgage, car loans, business loans often get cheaper, making it easier to spend and invest, which obviously stimulates economic activity. Higher asset prices, we've seen that. All you need to do is look at an S&P 500 chart or a Dow chart. QE pushes money into stocks, into bonds, and also real estate. This is why markets often bounce during QE. And I guess it depends how you look at this. It will weaken currency. QE printing money can lower the value of the dollar, if we're using America as the example here, compared to other currencies, which affects imports, exports, and even travel. Now, what do I mean by that? Well, if the dollar's really weak, it's going to increase US exports. If it's on the flip side of that, it's going to make importing much more expensive. And, there's arguments to and for this, that a weak dollar, because it's the global currency, generally isn't the best thing. Then you have inflation risk. Too much QE for too long can overheat the system, driving up prices for goods and services. So whether you're a homeowner, investor, or you're just buying groceries, QE influences your daily life more than you might think. So to wrap up, quantitative easing may sound like technical jargon, but really it's the central bank's way of flooding the economy with money. When times get tough, it can boost growth, support markets, prevent crises. But if overused, it really risks bubbles and inflation. And we've already seen inflation. And are we in a bubble? Well, we're going to cover that more in future videos. So the next time you hear about QE, you'll know it's not just some abstract policy. It's a decision that can move markets and touch your everyday finances. So if this helped you understand QE, make sure and hit the like button, hit the subscribe for more breakdowns on money, markets, even drop a comment. Do you think QE is a smart solution? Or is it just kicking the can down the road? Do you think it's been overused? I would love to hear your opinions on it. You can also drop us an email at info@expatmoneychat. Thank you for watching, much appreciated.